Somebody's got to figure out a way to de-risk that choice so that it becomes a rational choice for the government to choose that innovative solution over business as usual. How would they have normally paid for this? Municipal bonds. So let's start there. Let's see if we can. Let's not invent something new and scare the capital markets to death, and terrify everybody along the way. Let's build off of what we already are using. So we worked backwards with the municipal bond and said, how can we create a situation where the bond buyer for this bond to fund the green infrastructure shares in some of the performance risk of the green infrastructure. And to do that, you've got to figure out what the bond buyer would be betting on, if you will. What's the metric? What's the outcome metric? We were able to model that and get that into a normal curve with some confidence intervals. And then that became a simple predictive model of how well the green infrastructure would perform with that gradation, that climate, that soil composition, all the factors. And then all we did was layer interest rates over that normal curve, meaning we think it's going to perform in the middle of this normal curve, right? And therefore, we'll make that interest rate whatever the normal interest rate would have been at that particular time, floating into plain vanilla municipal bond. However, in the far right tail, which is the overperform, meaning if in 5 years we open up the magic box and we learn, hey, this thing did twice as good as we thought it was going to do, which would be fantastic news because DC would save about $175 million. Let's make the interest rate for that far right tail be twice as much, right? Because if the city is saving $175 million, happy to pay a bonus payment out to the bondholder of a few $1 million. And then on the downside, in exchange for that upside wonderfulness to the investor, where they're both sharing in that upside, on the downside, what if it doesn't work? Then that interest rate would be, call it 0%.